Hi, my name is Eric Martineau, and today I want to answer for you what are the basic benefits of private equity banking. First, you get tax-free growth. Second, you get guaranteed returns. Third, you get liquid cash whenever you need it. Fourth, you get protection against creditors and the economy. Fifth, you get compounded interest. And lastly, arbitrage. Now, these two are the most important to me: tax-free growth and arbitrage. Let's begin with tax-free growth. You get tax-free growth both of the growth of your cash value account as well as you can use your cash value account tax-free. Let me state something before we get into taxes. The Supreme Court has ruled, let's read this: anyone may arrange their affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the Treasury. Another finding by our Supreme Court says there is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Speaking of taxes, what do we have to pay tax on? Well, how about the debt? Has anybody gone out here to U.S. debt clock recently? You'll note that the U.S. national debt is $31 trillion with a T. And our unpaid liabilities are $172 trillion. How are we going to pay for that? Probably with taxes. Well, if you look at the marginal tax rate since 1908 when we first got it, and you look at today, a couple making $450,000 a year pays a marginal tax rate of 23.69%. In the grand scheme of things, that isn't that high of a tax rate compared to where it's been. But let me ask, with $31 trillion in debt right now and another 172 in unpaid obligations, tell me, what do you think is going to happen to taxes over the next few years? Regardless of whether we have a blue president or a red president, where do you think taxes are going? All right, so you get tax-free growth, which is huge in my opinion, because I believe taxes are only going to grow. Now, this gentleman here, Ed Slott, he has been called America's CPA by USA Today and the New York Times. And he put out a couple years back this program here called Retire Safe and Secure. In there, he said the following, and I quote, "The tax exemption for life insurance as a taxable income is the single biggest benefit in the tax code." Let that sink in. Let me say that again. The tax exemption for life insurance is the biggest single benefit in the entire tax code. Now, my father was an IRS agent. In fact, he was a special investigator, spent his entire career at the IRS. I think he was a GS 13 or 14 when he finally retired. But, he pointed out to me that there are over 80,000 pages of IRS code, statute, and case law. Yet only about 30 of those or 40 of those pages tell us how to pay our taxes. The rest of it teaches us how not to pay taxes. So back to Ed Slott. In this program, Retire Safe and Secure, he gives us 5 strategies for retiring safe and secure. And his number one strategy is turn taxable money into tax-free money using the tax exemption for life insurance by moving your money from the forever taxed environment to a never taxed environment. What do you mean never taxed? You mean there's 2 types of money? Yes, and quite frankly, this is one of the most difficult things I do as a practitioner of high cash value insurance policies, is to help people understand that you can't compare apples to oranges. What am I talking about there? Well, so often when talking about financial products, what you'll hear people talk about are taxable products, right? And then they try to compare them against a non-taxable product, which is a life insurance policy. And it just doesn't work. Look, we all know there are taxable buckets. Whether that taxes have to be paid today or those taxes are paid in the future, both of those buckets, income, dividends, investment gains, or our qualified plans, whether we pay it today or we pay it in the future, it's still a leaky bucket we have to pay taxes on. The other kind of bucket, and my favorite, is the death benefits and insurance loans. Both of those are tax-free for life. And that's what he's talking about. So back to Ed Slott. All he's saying is to move that money into a never taxed pocket. So if you move $200 from the forever taxed into the never taxed bucket or pocket, you've just moved $200 out of an arena that can ever be taxed again. And if you can get all 400 over it, that is why I believe the New York Times has called private equity banking the secret of the affluent. Because the affluent have figured out how to move more of their taxable income into a non-taxable environment forever. All right, what would I suggest then? Because tax rates really are historically low, and I think they're only going to up, I usually suggest to people, lower your taxes as much as possible today. So go talk to that good CPA you've got or that tax attorney and get them to lower your taxes as much as possible. Again, keep in mind that just because you can lower your taxes today by moving something out into the future, if all you're doing is deferring your taxes into the future, I'm not sure the IRS has given us a great deal. What's more valuable to the IRS? A barrel of corn seed today or an entire field in the future? That's why I'd rather pay my taxes now. I also believe that they're going to go up. But again, that's between you and your CPA and tax advisor. But I say pay your taxes now and then get as much of your money out of the taxable environment and move it into the non-taxable environment. Okay? And then use arbitrage to access those funds. I'll talk about arbitrage here in just a minute. Okay? The point I want to make here is I still have access to both pockets. So whether I have $400 in the forever taxed pocket or I have $400 in the never taxed pocket, I still have access to my money. It's still mine. I still have $400. So this is the question we're going to ask today and answer. Which pocket is better? Forever taxed or never taxed? All right, the second one, guaranteed returns with zero market risk. This again is one of the powerful tools of a high cash value insurance policy. There are guaranteed returns. The IRS calls this a cash accumulation contract. Contract being the key word there. And that contract will guarantee you compound interest on all your dividends for life. And once again, this is not market-based, right? There is no risk involved. So let me ask you, how much of your financial security comes with guarantees? Again, I don't care if it's 100 here and 300 there, or 200 and 200. It doesn't matter to me. This is up to you. But ask yourself that question. How much of your financial security comes with guarantees? And if there isn't enough of it with guarantees, maybe you should move more of it into that environment. All right, private equity banking. When we're speaking about the functions of money, we've got the banking function, the investing function, and the spending function. Private equity banking falls in the category of banking, the warehousing and borrowing of our money. It does not fall into the category of investing or spending. I put a bar there to kind of delineate that, right? So once you've put your money into this warehouse, it stays there forever. But you just said we have anytime access. You do. What you do is you borrow that money to get that access, and then you can use that money to either spend or invest. Now, I use the term borrowing, but really what we're doing is arbitrage, but I'll get to that in a second. When you decide to take some of the money that's warehoused and move it into an investment or a spending environment, all you're really doing is duplicating your money. You're using it twice because you use the money sitting in your warehouse as collateral, and then you are given a loan by the insurance company for the spending or investing. I'll show you how that works in just a second with real numbers. But just remember, you've got access to both. All right? One more point I want to make is, and most people don't confuse the spending side of it, but they do the investing, because a lot of people think that because it's got that compound growth and a warehouse will continue to grow and grow and grow, and it'll outstrip, say, a taxed market fund that has variation in it, they think it's an investment. It isn't. For me, investing is this. Investing is taking money out of my warehouse and starting a business where I hope to 400x my money. Or I take my money out of the warehouse and I invest it in a home and I hope to get, or a property, a fourplex or whatever, and I hope to get 20x on my money, right? Or I study a certain industry that I think is going to grow and I buy stocks in companies in that industry. That is investing to me. But in each of those cases, I'm putting my money at risk. And since I'm not putting my money at risk while it's in the warehouse, I don't consider that an investment. So please don't confuse or try to compare apples to oranges. One is a warehouse and the other is investing or spending. All right, liquid cash. This is not a qualified plan. So this isn't like a 401k or your TSP that you got in the military. This isn't that, all right? You have access to your cash for whatever you want. You have access to your cash whenever you want it. You have no age restrictions, no credit checks, no loan application, and no loan approval process, as you would say with a bank, right? All you do here is ask for your money, and 2 days later it's deposited back into your account. Protection. There are unique protections involved in a cash value accumulation account. One of those unique protection is from creditors. Another is from lawsuits. Let's face it, the more money you've got, the more equity you have in your home, the more lawyers are coming after you if you get into a stupid car wreck, right? So you get special protection. Here's the reason why. In a high cash value insurance policy, you have the owner, you have the insured, and you have the beneficiary. There are 3 parts to this. The owner and the beneficiary can be modified anytime you want. The body that's being insured has to remain the same. But this is the thing. The owner has control of the cash value while the owner is alive. Let's say I'm the owner of a policy. I get in an accident. An attorney wants to come after the cash value that I have in a policy. They can't get it. Why? Because the courts have deemed that that money belongs to the beneficiary. Exactly. So you get special protection there. You also, because of the contract and the guarantees, you have protection from microeconomic swings as well as macroeconomic trends. Who'd have thought that COVID was going to wipe us out, or whatever else, 2008, that the housing market would implode, right? So here's the question again I like to ask. How much of your financial security depends on people, companies, economic situations that you can neither predict nor control? Let me say that again. How much of your financial security depends on people, companies, economic situations that you can neither predict nor control? There's no right answer again, right? If you want 25% of it in a predictable environment, put 25% in. If you want 75% in a predictable environment, put 75% in. Again, that's up to you. Compound interest, we all understand what that is. I like this quote by Albert Einstein. Compound interest is the most powerful force in the universe. Those who understand it, earn it. Those who do not understand it, pay it. Let that sink in, coming from Albert Einstein. Again, we all know what compound interest is, right? It's taking the initial principal and adding into it the compounded interest. But let me ask you a question. Once again, we're comparing a non-taxed environment to a taxed environment, right? If I have money sitting in a tax environment and I get let's say I get $20,000 in dividends from my stocks, what do I have to do on that $25,000 or that $20,000? I have to pay tax. And if I'm in the 25% tax bracket, guess what? I've just paid $5,000. Now my 20 becomes 15. But if I've earned $20,000 in dividends from my cash value insurance, guess how much of that is taken out for taxes? 0. Again, not only does the cash value grow eternally without end until you pass away, not only does the cash value grow without interruption, so do the dividends in a cash value insurance policy. All right, and lastly, arbitrage, my favorite. Arbitrage, this is the definition: the simultaneous saving and borrowing of currency in 2 different accounts to take advantage of different interest rates for the same asset. Let me explain that a little bit better. The IRS calls this a cash accumulation contract. Again, contract is the key word there. And in your contract, it's going to spell out how much interest you make for all of your cash value, dividends, guaranteed portion, all of it is right there, getting a specific amount of interest rate, right? And then how much you can borrow at is also stipulated in the contract. Now, most of these run somewhere between 4 and 6%, right? But that's where those are at today. Okay, as I showed just a second ago, here's how this works. You've got $400 sitting in your cash value accumulation account, and you want to pull out $200 to either spend or to invest, right? So you got 2 over there for investment and 200 for spending. Now, You have to borrow that money from the general ledger of the insurance company to get that. And I say borrow, but you're really not borrowing, because if you were borrowing, you might be taking all the money out of that cash value accumulation account, and you're not doing that. So really what you're doing is arbitrage. You're using your money twice. Your money sits in your cash value account and continues to grow. But they match that and give you $400 to either go spend or invest. This can only be done in an insurance company. It can't be done at a bank. So how is it done? Let's say I want to buy a car, and I've got a cash value account with $50,000 sitting in it, right? I go then, and I don't pull my money out of my cash value account. I go to the general fund of the insurance company, and I say, hey, I want $50,000, and I want my cash value to act as the collateral. They give me another pot of $50,000. Now, on my original cash value, I continue to gain compound interest the entire time it's sitting there. They don't punish me for that, right? And then on the general fund, as I go paying back down that loan, right? Private equity banking, so I'm paying myself back as though I was a bank. I'm paying back both principal and interest. Those two are shrinking. So over time, my cash value account continues to grow, whereas the principal and interest side continues to shrink, until finally I've paid off that automobile. I have no debt to the general fund of the insurance company, yet my cash value account has continued to grow that entire 5 or 6 or 7 years, whatever it took me to pay back that loan. I hope that makes sense. If not, let me show it to you one more way. Here's how it works. Let's say I've got that $50,000 sitting in that account and I'm earning 5%. That becomes my collateral. I want to buy a car. Let's say I'm paying 5%, right? And I want to borrow $50,000 at 5%. And I'm going to do it over 5 years because that's a normal term for a vehicle. So here's my car. My cash accumulation account has $50,000 in it, and in year one, earning 5% interest, it's going to grow to $52,000. The next year it's going to go to $55,000. The year after that, $57,000. The year after that, $60,000, and finally in the fifth year it will have grown to $63,814. That's a gain of $13,814. But wait, remember I borrowed money from the general fund of $50,000. And let's say I went out and saw an amortization chart and I decided I need to make X amount of dollars payment to pay that off in 5 years, which is what I would have done if I had gone to Volvo, Finance, or whomever, right? So I make those payments religiously as though I had a structured loan. Even though these are unstructured loans, I don't have to pay it back. So I fall on hard times, I don't have to make the payment because it's unstructured. But let's say I pay it back in a structured fashion. Year one, I'm going to pay down this note to $43,000. Year two, $33,000, $24,000, $13,000, and finally in the fifth year, I pay off that note. Well, how much total interest did I pay? $6,614. The difference between $13,814 that I earned on my cash value versus the $6,614 that I paid in interest back to the general fund of the insurance company is a total of $7,200 positive arbitrage in my favor. Let that sink in. This is the power of private equity banking. I hope that sinks in. That is arbitrage, and that is the power of what we're doing here. All right. Banking methods. Trying to compare apples to apples now. So now that we're not trying to compare a cash value account against an investment, let's talk about what we really are comparing it against. What we're talking about here is different banking methods. The method of banking with a traditional bank or the method of banking with an insurance company. That's what we're really comparing here. So same car example. I want to buy a car. I'm a saver. I start at zero. So in year one, I put $10,000 in the bank and I save it. And the next year I put another $10,000 in. And the year after that, another $10,000. The year after that, another $10,000. And finally, I've got my $50,000 and I go buy a car. And then I start saving for the next car because I'm going to have it for 5 years. So I save another 10, another 10, another 10, another 10, and I get another 50,000 and I go buy another car. And I go right back down to zero and I start again. And I put another 10 and another 10 and another. And finally, after 5 years, I've got another 50,000 and I can buy another car. That is the saver's way of buying in a bank. The other method is obvious. It's the way that most of us do it, the debtor way, right? Boom, I want my car now. So I go and borrow $55,000 instead of $50,000 and I pay it back over time. And I get back to zero. And then I want to get another car, I go buy another car, and again I pay down on it year to year, month to month until it's paid down. In both of these cases, what am I doing? After I've paid down or saved up, I go to zero. And that is the paradigm that I hope we break. You see, we think there's only two methods of purchasing large ticket items. We save, spend, and go to zero, or we borrow, pay back, and go to zero. Now let me introduce you to the third way of doing things, and that's through an insurance company, letting it be your bank, and let's call this the wealth creator. Now the wealth creator mentality starts about the same as the saver. You put in the 10K each year until you get to 50,000. But now when you buy your car, you're really using your 50,000 that's sitting there as collateral. You're borrowing 50 from the general fund of the insurance policy, right? And then you're paying that back. Again, you have both of these accounts. They're both, one's costing you interest, the other one is giving you interest, but you pay them back over time. And at the end of the day, when you've paid off the car, your cash value has 63,000 in it and you have zero debt for the car. Note too that your cash value account never went to zero, like it would have with a debtor or with the saver model that I just showed you. So you're at zero, you get your car, and then you want another one. So you do it again. You borrow for another car and you pay it off over 5 years. And now what happens at the end of those 5 years? One, you've paid off that second debt, right? It's gone. You now have more money in your cash value accumulation account. You do it again, you get the idea. You pay that off, bingo. Now you've got even more money in your cash value account. That has never been reduced once during this entire process. And you still have 3 cars. So what's the big difference? Simple. The delta right there. Infinite wealth creation. This is how the uber wealthy purchase large ticket items. They shove it into a cash value accumulation account, they let it grow infinitely, and then they bank on themselves. Pretty cool process, isn't it? Quick overview once again. Tax-free, use and growth of your funds, guaranteed returns, liquid cash anytime you want it, protection against undesirable economic situations as well as lawsuits, compounded interest both on your cash value and on your dividends, and arbitrage. That is the power of high cash value accumulation contracts. I hope you enjoyed it. Get with me and I'll walk you through a prospectus for you. Have a great day.